We've also got to talk about First Republic this morning. It's up slightly following its downward plunge, but still down over 17% in the last 2 days as pressure mounts. But our next guest is pointing a finger at two individuals for the lender's downfall: Fed Chair Jerome Powell and Treasury Secretary Janet Yellen. Chris Whalen, Whalen Global Advisors LLC Chairman, joins us now. Chris, great to have you here with us this morning.
Good morning.
All right, so what's up? Why is it Jay and Secretary Yellen's fault?
Well, particularly Chairman Powell, but also, I think, Secretary Yellen, were advocates of a strategy that's called Go Big at the Fed. After 2018, you recall at the end of the year, we had a big problem in the money markets. And so I think Chairman Powell and some of his colleagues panicked in Washington, and they decided to provide more reserves. They did so in 2019. And then we had COVID, and they even went bigger. And they expanded the Fed's balance sheet to almost $9 trillion. So what they did, in essence, was throw a lot of money at a perceived problem, but they've created a real problem now, which is that interest rates have risen. All the paper that was originated in 2020 and 21 is now trading 15, 20 points below the price where it was issued. And the banks are facing huge losses. Also, other investors, bond investors, REITs, all sorts of people that own these high-quality AAA-rated securities. We're talking about treasuries, ginnies, fannies, freddies, right, which are supposed to be low risk, but the Fed has created huge market risk. And so these outliers like Silicon Valley, First Republic have tipped over in a difficult funding market. And even JP, even Bank of America, you can see how their cost of funds is rising. It's very rapidly year over year.
Their cost of funds is rising, Chris. Hey, it's Julie. It's good to see you.
Hey.
Their cost of funds is rising. However, the whole issue of unrealized losses sitting on their balance sheets, like that in and of itself, isn't that much less of an issue? Isn't it even almost a moot point at the biggest banks, at everybody besides the banks that seem the most distressed? I mean, those banks don't have to do anything with that stuff, right?
No, you see, that's the issue. In a way, yes, it's an optics problem. So back at the end of the third quarter last year, it was horrible. It was almost $1 trillion in mark-to-market losses on available for sale and also held-to-maturity securities. But the problem, Julie, is that we originated $25 trillion worth of securities in 20 and 21 of all descriptions. That paper has very low cash flow. So if I'm holding Ginnie Mae 2s and my cost of funds is now 5, I'm losing money, okay? And so the embedded cash flow loss is the problem. And that's why you've seen some banks actually taking assets to the curb, taking the loss on a 2 or a 3% asset, right? So they can go buy a 6 or a 7. And the whole industry is going to have to do this, Julie. They have no choice. The banks that move with purpose and move quickly, I think, are going to do well. But the ones that can't restructure, that don't have the income, like First Republic, they're in big trouble. Because, First Republic, most of their balance sheet is whole loans, stuff they originated themselves, interest-only mortgages, which are difficult to sell. These are, jumbo private label mortgages. You don't sell these to Fannie and Freddie. So they have a much higher funding cost, and there's other aspects too.
I guess,
so the whole industry.
Chris, I guess what I'm trying to understand though is, and I know everybody has talked about that there's going to be lower loan growth. That's going to be a crimp on bigger economic growth. But I guess beyond that, I'm trying to figure out what the broader implications are. Like if First Republic goes out of business, which it's still not, right? It hasn't yet. We don't know what's going to happen with First Republic. If it goes out of business, okay, so First Republic goes out of business. Okay, so the banks are less profitable and they're not lending as much. But we're not talking about a systemic, huge issue, are we?
No, I think you are. It's like the 1980s when Paul Volcker was chairman, and he raised short-term interest rates, and the S&Ls could not adjust because they had fixed-rate mortgages on their books. In this case, the banks can adjust slowly, but they can't adjust in a year. And what the Fed has done is they've raised, T-bill rates up to 5%, and JP Morgan and the other banks have a cost of funds that's still around 1. So they're not competitive, and they are going to have to change their cost of funds to compete with the Treasury and compete with other alternatives. See, the narrative said the big banks would be advantaged in this situation, Julie. That's not the case. All banks are competing now with Uncle Sam. And that's the difficulty, because they can't just sell these bonds and take a 10 or 15-point loss. That's the issue. So look at First Republic. The industry is saying, we're not going to clean up this mess. This is your problem. Okay? That's the little standoff that's going on with First Republic right now.
If First Republic is not saved, is there a banking crisis in sentiment, at least, that continues to prevail?
I think it will seriously impair bank earnings, because let's remember, it's not the Treasury that stands behind the FDIC. It's the banking industry. They paid in 2008. They cleaned up most of the mess. And this time, they are already going to have to pay for Silicon Valley and Signature. The sale of the Signature assets is not going to go very well. They're going to be lucky to get 50 cents on the dollar for what's left. So that's going to be a loss to the industry. The industry doesn't want to get stuck with this because they perceive it as the Fed's problem, Julie. The Fed did this by doing too much in the bond market. And they've created a horrible problem because, remember, the mortgage securities that they bought in 20 and 21 have now extended their durations to 15 and 20 years. And that's a huge problem for the bond market. So, I think Yellen and Powell both have issues to deal with that they don't really want to explain in Washington because nobody wants to hear it. But they do have a real problem with the banking industry. You're going to see more bank failures as a result of this.
Well, I mean, there are always bank failures, I guess. To your point, though, it's the question of
not the last
bigger
decade. We've had a decade of bliss and really benign credit conditions, and we're now about to go the other way. So by the third quarter, we're going to be talking again about credit. That's going to be the headline.
All right, we'll check back in. Chris Whalen, Whalen Global Advisors, LLC Chairman.
My pleasure.
Thank you so much. First Republic, by the way, the shares are now bouncing back. For whatever reason, they've been paused a couple times for volatility, so we'll keep watching that.